Hello and welcome to my YouTube channel, where I share with you secrets of the financial matrix we live in. In this video, I'm going to show you how to value a company's stock using different methods and tools. First, I have to add the disclaimer. The information in this video is for educational and entertainment purposes only. It is not intended to be financial advice or a recommendation to buy or sell any securities. I am not a financial advisor and I do not have any affiliation with any of the companies or products mentioned in this video. You should always do your own research before making any financial decisions. Without further ado, let's get into it. Valuing a stock is an important skill for any investor, because it helps you decide whether a stock is cheap or expensive relative to its earnings, growth, assets, or cash flow. There are many ways to value a stock, but I'm going to focus on 4 of the most common ones: the price-to-earnings ratio, the price-earnings-to-growth ratio, the price-to-book ratio, and the free cash flow method. The price-to-earnings ratio, or PE ratio, is one of the simplest and most popular valuation methods. It measures how much you are paying for each dollar of a company's earnings. To calculate the PE ratio, you just divide the stock price by the earnings per share, EPS. For example, if a company's stock price is $50 and its EPS is $2, then its PE ratio is 25. This means you are paying $25 for every $1 of earnings. The PE ratio can help you compare different companies in the same industry or sector. Generally, a lower PE ratio means a cheaper stock, and a higher PE ratio means a more expensive stock. However, you should also consider other factors, such as the growth rate, the quality of earnings, and the industry average. A high PE ratio might indicate that the market expects high future growth, or that the company has strong competitive advantages. A low PE ratio might indicate that the market is pessimistic about the future prospects, or that the company has low profitability or high debt. The price-earnings-to-growth ratio, or PEG ratio, is a variation of the PE ratio that takes into account the expected growth rate of a company's earnings. To calculate the PEG ratio, you divide the PE ratio by the annual EPS growth rate. For example, if a company's PE ratio is 25 and its EPS growth rate is 10%, then its PEG ratio is 2.5. This means you are paying $2.50 for every $1 of expected earnings growth. The PEG ratio can help you evaluate whether a stock is overvalued or undervalued based on its growth potential. Generally, a lower PEG ratio means a better value, and a higher PEG ratio means a worse value. A rule of thumb is that a PEG ratio below 1 indicates an undervalued stock, and a PEG ratio above 1 indicates an overvalued stock. However, you should also be careful about using projected growth rates, as they can be inaccurate or unrealistic. The price-to-book ratio, or PB ratio, is another common valuation method that compares the stock price to the book value of a company's assets. The book value is the difference between the total assets and the total liabilities of a company. It represents the net worth of a company if it were to be liquidated today. To calculate the PB ratio, you divide the stock price by the book value per share, BVPS. For example, if a company's stock price is $50 and its BVPS is $10, then its PB ratio is 5. This means you are paying $5 for every $1 of book value. The PB ratio can help you assess how much a company's value comes from its tangible assets, such as cash, inventory, property, plant, and equipment. Generally, a lower PB ratio means a cheaper stock, and a higher PB ratio means a more expensive stock. However, you should also consider other factors, such as the quality of assets, the return on equity, ROE, and the industry average. A high PB ratio might indicate that the company has strong intangible assets, such as brand name, patents, or customer loyalty. A low PB ratio might indicate that the company has low profitability or high risk. The free cash flow method is another popular valuation method that focuses on the cash flow generated by a company's operations after deducting capital expenditures. Free cash flow, FCF, represents the amount of cash available to shareholders after reinvesting in the business. To calculate the FCF per share, FCFPS, you divide the FCF by the number of shares outstanding. For example, If a company's FCF is $100 million and its number of shares outstanding is 50 million, then its FCFPS is $2. The free cash flow method can help you estimate how much a company's stock is worth based on its ability to generate cash for its owners. Generally, a higher FCFPS means a more valuable stock, and a lower FCFPS means a less valuable stock. However, you should also consider other factors, such as the growth rate of FCFPS, the cost of capital, and the industry average. A high FCFPS might indicate that the company has strong cash flow generation, low capital intensity, or high margins. A low FCFPS might indicate that the company has weak cash flow generation, high capital intensity, or low margins. These are just some of the most common methods to value a stock, but there are many more that you can explore and use. The best way to value a stock is to use multiple methods and compare the results. You should also do your own research and analysis, and not rely solely on the numbers. Remember, valuation is more of an art than a science, and there is no one right answer. But if you got to this point, you are probably wondering, where do those numbers we just analyzed come from? So before I end this video, because I know you are serious about stock investing, I'm also going to explain what financial statements are, why they are important, and how to read them. Financial statements are documents that summarize the financial performance and position of a company or an organization. They are prepared by the company's management or accountants, and are usually audited by independent external auditors. Financial statements are essential for investors, creditors, regulators, and other stakeholders who want to evaluate the company's profitability, liquidity, solvency, efficiency, and growth potential. There are three main types of financial statements: the income statement, the balance sheet, and the cash flow statement. Each of these statements provides different information about the company's financial activities during a specific period of time, usually a quarter or a year. The income statement, also known as the statement of profit and loss, shows the revenues and expenses of the company during the period. It tells you how much money the company made or lost from its core operations, as well as from other sources such as interest, taxes, dividends, or extraordinary items. The bottom line of the income statement is the net income or net loss, which is the difference between the total revenues and the total expenses. The balance sheet, also known as the statement of financial position, shows the assets, liabilities, and equity of the company at a specific point in time, usually at the end of the period. It tells you what the company owns and owes, and how much it is worth. The basic equation of the balance sheet is assets equals liabilities plus equity. This means that the total value of the company's assets must equal the sum of its liabilities and equity. The cash flow statement, also known as the statement of cash flows, shows the inflows and outflows of cash from the company's operating, investing, and financing activities during the period. It tells you how much cash the company generated or used from its various sources and uses. The net change in cash is the difference between the opening and closing cash balances. These three statements are interrelated and complementary to each other. They provide a comprehensive picture of the company's financial health and performance. By reading and analyzing them, you can learn a lot about the company's strengths and weaknesses, opportunities and threats, risks and rewards. So to recap, there are many ways to value a stock. 1. The price-to-earnings ratio. 2. The price-earnings-to-growth ratio. 3. The price-to-book ratio. 4. The free cash flow method. These ratios are usually readily available on the stock listing straight your preferred search engine. Now that you know what they are, you can value company stocks yourself and make smart investing decisions. However, you can calculate these ratios yourself by pulling the underlying numbers from the company financial statements. Doing this extra exercise may give you a better feel of what you're about to invest in. I hope you found the video helpful and useful. If you did, please give this video a thumbs up, leave a comment below, and share it with your friends. And if you want to learn more about similar topics, make sure to subscribe to my channel and turn on the notification bell so you don't miss any of my future videos. Thank you so much for watching. Keep working hard, keep learning, and keep moving closer to your goals. You can do this. And I'll see you in the next one.